Hi everyone, this is Mike Minter, Chief Investment Officer with Financial Synergies Wealth Advisors. Just going to walk you through a brief second quarter market and economic summary. Try to keep it short and sweet, but we'll break it down into two kind of overriding sections. So we'll talk about the markets, and then we'll talk about the economic factors that were kind of surrounding that first half of the year and second quarter, and then we'll kind of conclude. But we're going to try to do more videos. I know we do a lot of written content, blogging and such, and had some requests for more video interaction and things like that. So we're going to make a real effort to do regular videos and market commentary. So hopefully you guys find this useful. Okay, so let's get started. So we're going to look at the Q2 markets. Nice little bull dropping in here. Are we in a bull market? So that's a question we get a lot. The answer in a technical sense is yes. We are in a bull market. Technically, more than 20% off the most recent lows. And so, although sometimes it can't feel like a bull market, simply because 2022 was so horrific in so many ways, not only for stocks but also for bonds. So it was just a terrible market all around, to be frank. And coming out of that, sometimes it can take a while to feel like we're actually pulling out of that and on the road to recovery. But the fact of the matter is we are. We are in a bull market, and so things are looking up and have been throughout the year. So let's dive into that and find out why. So here we have the quarterly market summary. So this is just looking at the past 3 months, so Q2 of 2023. So we have the U.S. stock market, international, emerging, global real estate, and then the bond markets, not only U.S. but also global. You can see across the board, other than bonds, bonds had a little bit of a rough quarter, but not a terrible drop off. Nothing like we saw in 2022. But it's still been a rough environment for bonds. Interest rates are still going up, and so that sends bond prices down. It's a tough place to be. We know we'll come out of it, but right now it's not a very fun place to be in fixed income. But long term, no question about it, we will get back on track, and fixed income will be healthier because of this. But the U.S. stock market is just raging, up 8% for the quarter. International up 3%, emerging markets up just shy of 1%, and global real estate again just kind of shy of that 1%. So all around, just a fantastic quarter, and we can kind of see this average quarterly return down here as well. I'll grab my little pen here and see if I can just highlight this. So what we've got here is just displaying average quarterly returns since January 2001, and you can see that by historical measures, this really is a fantastic quarter. U.S. stocks, 4 times the average. International, double their average on a quarterly basis. Emerging markets, not as much, but all in all, the majority of the equity positions are doing quite well, even from a historical perspective. So all in all, just a really strong quarter. Okay, so let's kind of broaden that out a little bit. Let's talk about the long-term market summary. So here we're looking at a 1 year, 5 year, and 10 years. Again, really phenomenal numbers across the board. I mean, other than real estate and bonds, which we've kind of talked about bonds, the environment we're in and have been in. Global real estate is really dramatically affected by interest rates. It's very rate sensitive, and so that sector has really been a tough place to be, frankly. But obviously things are cyclical, and we know we'll rebound in all these areas. And that's just looking at a 1 year period. If you broaden that out and look at longer term, 5 year, 10 year, things start to more normalize out. But you can see the real strength has been in the U.S. stock market. Not bad on the international side at all, but it's just nothing can compete with the U.S. market over the last 10 years and beyond. And so it's been a great place to be. Now, we have a home bias, obviously, and the U.S. being the largest market capitalization, obviously we're overweight there and happy to be there. But on the international side, it won't always be that way. International will outperform U.S. at some point, and we've seen that. We've seen that over long periods of time, even from '99 to the end of 2009. We saw just extreme outperformance on the international side. So things ebb and flow, and we want to make sure we have exposure to everything. So. Okay, so let's kind of look at some highlights. I just thought this was really interesting and kind of cool. My little rocket ship there to the moon, kind of cheesy, but here we have the NASDAQ up 32% for the first half of the year. Its best first half since 1983. Pretty astonishing. Now, part of that obviously is because last year was so horrific. It's a rebound and a bounce off of that. I get that. There's no question about it. But it is still nice to see such a strong recovery in an area that just got absolutely hammered last year. So nice to see that turnaround. Is that indicative of, hey, we're going to extrapolate that out and end of the year, NASDAQ will be up 60%? Not likely. I get that. Things always kind of return to the mean, and all those things tend to normalize. But it has been a stellar first half. I don't anticipate it just continuing on this rocket ship ride. We want to see a broader kind of participation and rally in the markets, which we are starting to see. You're starting to see. You can look at this chart here. You can see the S&P, the Dow, and the Russell. Obviously, the S&P doing extremely well. All the indices having a nice first half, but it is good to see they're starting to participate on a more broad level. So, but this first half has been absolute tech domination. You can look over here to the left side. You've got Apple, Microsoft, Amazon, Nvidia, Alphabet. These are actually the top 5 holdings in the S&P 500, and these things are just screaming right now. Apple up 50, Microsoft 43, Amazon 55, Nvidia up a whopping 190%, and Alphabet 36%. So just a phenomenal start to the year for these tech names. Again, we're looking obviously for broadening that out. It's tough to have a sustained rally if you just got super top heavy in just one sector, but it is starting to broaden out. So that's the good news. Okay, so moving on, let's take a look at breaking that down even further into sector returns. So this is year-to-date sector returns. And if we look at this, it kind of follows that story that we were just looking at on the previous slide, right? You've got tech domination here, 46% for the year. And then on down the road, you got communication services, consumer discretionary. Communication services is also fairly heavy tech. So you're seeing really domination in these particular sectors. As we move on down the road, you can see energy, things like that have kind of struggled this year. It was not the case last year. Energy was just a very strong place to be, and so you kind of see that trend reverse this year. So as things always do. So interesting to see that sector breakdown. Okay, so that kind of concludes the markets. Let's switch gears a little bit and talk about the economy. So what occurred and kind of where are we? Recession coming or soft landing? That's been a big question on everybody's mind. We get that question a lot. The answer is, of course, we don't know if we're gonna avoid a recession and the Fed is going to be able to achieve this soft landing. We don't have the answer to that. But if I were a betting man, and I'm not, but I would probably say the Fed is on track to maybe avoid a hard and fast recession. I think it's possible they actually achieve this soft landing. So, which means basically at the end of the day, that's just a slowdown in economic growth, without a complete and total, wreck of the economy is essentially what that means. So yes, of course, things have slowed down, but can we get out of this without just, massive damage and unemployment and those things? The answer to that question may be yes. So let's take a look at this here. So it's been a very interesting and tough time. So What we're looking at here is an economic update just kind of across the board, and we're looking historically, but also looking at some projected numbers here. So you can see in the darker areas, these are actually projections of things that may come. So when you get into the second quarter of 2023, is what we're talking about now, there are some projections as to where things will shake out. I know this is a little small here, but what we can see here is that this real GDP number really, took a step backwards in the second quarter of 22, and that's indicative of this inflation number as well. I mean, we're talking about a 9% inflation number, which is just kind of off the charts. And then you see as the quarters continue and we get further down the road that this inflation number has continued to come down. We are now, kind of getting into a more normalized range. I wouldn't say acceptable yet by any means, but more normal. So real GDP has stabilized to some degree, obviously taken a hit, and the projections are that it will probably continue to take a bit of a hit probably into 2024. CPI is the inflation number, consumer price index is the inflation number we're looking at here. That has been on a steady decline, and that is a very, very good sign for the economy and frankly the markets going forward. So that's continued to decline. Unemployment has been really the star of the show. This has been shockingly stable throughout this entire environment. Obviously, we took a hit during the pandemic, and we'll look at that. But this unemployment has been just really, really a rock for the economy, and frankly, a large reason why we have not gone into recession. It's very difficult to have a recession when you have very, very low unemployment. That's just historically been the case. So, and these are some rates down here at the bottom, and we'll talk a little bit more about that as well, as rates are increasing, but also projected to at some point start to slowly decline. And by the way, if you can't catch all this data and want to get more, I will include a PDF copy of all of this, whether you're viewing it on YouTube or maybe our website. I will have a link that you can just simply click on and download the PDF if you wish. Okay, so let's get into a little bit more granular detail on what we were just looking at. So this is CPI, this is the Consumer Price Index. We have the core CPI, which kind of excludes that food and energy, and then we've got kind of that headline CPI. So which can kind of jump all over the place on you. But the underlying kind of trend here is that although inflation in both of these cases, core and headline CPI, spiked up recently, it has come down substantially to much more reasonable levels and is continuing to decline. So Fed in a perfect world wants to be around that 2% inflation number, which, it's difficult to achieve that perfectly all the time, but that's kind of what they're striving for. So you can see CPI is not far off, it's 3%, but really what they're focused on more than anything is that core CPI number is what they tend to focus on more. So we've got a little ways to go on that. So bringing that core CPI number down is going to be important. Okay, so moving on to unemployment, which we looked at on the kind of that broad graph, but now looking at more granular. Yes, you can see an extreme spike up here during the pandemic and after the pandemic, but that was very, very temporary in nature, came back down to earth very quickly. So you have the U6 as kind of that underemployment rate. So, people not really finding the job that they want or what have you. And then you've got your flat out unemployment number at the U3 acronym there. So, we're seeing, and you can't really make this out on this graph very well, but this number has, since it came down after the pandemic, has been extremely stable. We're not seeing this spike up and seeing the normal conditions that would lead you into a recession in terms of unemployment just kind of steadily increasing or spiking up is just not happening. So that is a good sign. Now, wage growth is another interesting stat. So this was a little bit of a concern for the Fed. It can cause inflation because when you have extreme wage growth, it does tend to foster an inflationary environment. People are, got increasing incomes and more discretionary income and out there spending money, and that can cause inflation to keep going up. And so, yes, we needed wage growth. It had been some time since we even got up to, these average, historical average growth, wage growth numbers, as you can see by this line here in the middle. We've been well below that for, more than 10 years. And so starting to see that increase and make some gains there in wage growth was a good thing. It's a positive thing. But if you get too much of that, you really get an overheating inflationary environment, and so that's bad. So it's good to see that in this latest number, it's coming down. Although a very healthy growth rate, it is coming down, and that is a real positive for the economy going forward. It's a healthy thing. So let's back up here a minute, and not only are we going to look at interest rates spiking up here recently, I don't think that's any secret with the Fed continuing to raise rates to battle inflation. But this, at the end of the day, rates have been kind of the cause of all of this. So rates are a very, very powerful thing. One of the most important and powerful factors in economics and markets are interest rates. For 40 plus years, we have been in a declining rate environment up until very, very recently. Easy money, kind of let the good times roll, has been the trend for a 40-year period. So that has now reversed. And by the way, that's not, historically speaking, that's not normal. It's not normal to be, in this rock bottom, practically zero rate environment for this long. So it is actually healthy and better for us to have a more normalized rate environment, but getting there is extremely painful. And we've seen that. We've now experienced a very, very difficult year in 2022 for stocks and bonds. But we've turned the corner on that, and this year has been phenomenal for especially stocks, and hopefully bonds will come out of this. We know they will. It's just going to take some further time to digest. But this spike is this is the Fed doing their thing and raising rates to try to combat inflation. So here's where we are on that currently. So if we turn the corner now and just talk about where we are with the yield curve, I think this is always very, very interesting to me and a good indicator to look at. This is a dramatically inverted yield curve. This is where we are right now. This is not normal, and it's rare. But we are in an environment where, and I'm just going to get my little pen out here again. I'm going to actually draw this. So this is where we are now. It's called an inverted yield curve, and it's sloping down as you move out on the maturity scale. That is not normal. This would be a normal yield curve. So what this means in a normal environment is that the shorter maturity bonds are going to pay much lower rates than the longer maturity bonds for good reason. They should pay lower rates. They're much less risky, and you're not tying your money up for very long at all. We now have the opposite of that. We have on the front end of the curve, the very short-term rates paying way more than these bonds out on the longer end of this curve. Again, that is not normal. That is inverted. That is a direct result. Well, it's one of the direct results is the Fed raising rates, and they tend to affect the front end of the curve much more so than those increases affect the long end of the curve. It takes longer for those increases to make their way through the longer end of the Treasury maturity curve. So This will revert back, no question about it. It's only a matter of time. So what we're seeing right now is a result of the Fed's actions and increasing rates and it affecting the short end of the curve more. That will reverse, but this typically leads you, it can be an indicator and kind of a leading indicator into a recessionary environment. But that's not always the case. It's most of the time, but not all of the time. So the question is, can we get through this without a recession, given that there are many indicators that would suggest we're going to go into a recession? I think there's a shot we actually get to that point. The Fed actually accomplishes their goal of a soft landing. That unemployment number is huge. That is going to be one of the defining characteristics, I think, as we look back on this period. So that is our conclusion on the yield curve. So now we can kind of talk about where we are in terms of the Federal Reserve and their raising of rates. So we are nearing the peak rate target with possible rate reductions coming in 24. It's possible. Nothing is set in stone. A lot of that is going to depend on what the economy does. But you can see currently we're at this 5.375-ish, somewhere around there, kind of Fed number. And it's possible that we could, this is based on kind of where the individual members of the FOMC, Federal Open Market Committee members, kind of project things to be. So it's possible that we could get some additional rate hikes beyond what we've already seen throughout the year, but I think we are probably nearing the peak of those hikes, and they may not hike rates again, although it's very, very possible. And then we actually may start to see some reduction in rates leading into 2024. There's some big ifs there, obviously, but that is the way it is kind of trending. Just to kind of give you guys an idea. And that is a good thing. I think we're really going to benefit from that, not only economically, but the markets. Okay, so we got through the presentation. I really appreciate your time. So this is just real quick why Financial Synergies Wealth Advisors. For clients, I apologize for the shameless plug, but we just wanted, for all our viewers who are maybe not clients or want to know about us, here is the just 2-minute spiel. We are trusted advisors, $1.2 billion in assets under management, and about 750 client relationships. We are fiduciaries. We have a fiduciary duty to act in your best interest, meaning you always come first. We would do that even without the fiduciary duty, but we are legally and ethically bound to do that. Comprehensive experience in 35 years. We've kind of seen it all. We work through complex portfolios, address unique needs. We can offer a highly customized level of investment expertise. Transparent, fee only, no commissions, no monetary incentives outside of that, or conflicts of interest. We try to limit that to the very best of our ability. So you pay us for our services, that's it. We are not paid by some fund company or somebody hawking some products on us. We just don't work like that. So your interest first, period. Total wealth management. We offer various wealth management services. We think it's very, very comprehensive. Financial planning, investment management, tax planning, estate planning, all those things. If there is something that you need solved for and we can't do it in-house, we have strategic partners all over the city. We will bring it all together for you, and we will act as your quarterback, and we will get it done for you. So total wealth management, diverse portfolio solutions. We offer globally diversified investment portfolios with access to both public and private markets. There's really nothing we can't accomplish in the creation of your custom investment portfolio. So, okay, thank you for letting me get through that. I appreciate it. And finally, this is our information, our address, phone number, website, email address. Save this info, please. If at any point you want to discuss anything we've talked about here, or just talk about anything in general going on in your financial life, please give us a call. That's what we're here for. We would be honored to have that conversation, whether you're a client or not. Clients, please, of course, all the time, we are accessible to you. It's what we are here for. Anybody interested in our services, just reach out. we are an open book and we are always willing to talk. Thank you so much for your time today. I really appreciate it. This next slide is going to be extremely exciting. These are disclosures, and these will help you to take a nap. But if you so wish, here they are. So again, really appreciate your time today. We hope to speak with you soon.